What are your thoughts on the week that we just witnessed?
Well, I really think the stock market is still fully valued. And the fact that we're going to institute $300 billion worth of tariffs is not going to be compensated by any more Fed cuts. Earnings per share have been declining. They're actually down 1% on stated dollar earnings for the quarter. They're up about 2% because of stock buybacks. So I think the market is about 18.5 times earnings. The Russell 2000 and 2500, about 19 multiples. I think there's lots of risk out there because earnings momentum isn't good. And the GDP forecast for the United States and the world are decelerating. The estimates for next year are 1.7% real GDP, down from 2.5%. And world GDP is at 2.6 according to the World Bank. And so it's compounding the woes of both Europe and Asia. And interestingly enough, if you look at the trade data, which I did for the second quarter GDP release, the actual trade deficit in services and goods actually increased year over year, notwithstanding the tariffs. So it's having a deleterious effect on the world economies, and it's not doing anything for our GDP deficit, which actually equals 3.1% of nominal GDP.
So, Scott, gauge for us what your positioning is then at the moment. If you think stocks are fully valued, is this are your cash levels higher than they've ever been, or what? Give us a gauge.
No. Well, they're not way overpriced, and we try to stay fully invested. We're bottom-up stock pickers. But the problem is, if you look across a wide swath of industries, whether it's technology, autos, manufacturing, logistics, like the FedExes, the apparel companies like a Ralph Lauren, a PVH, they're all affected. They either source out of China, or some of these people are dependent on Chinese purchases. And we totally disrupted the supply chain world order here. And Mr. Trump, he's kind of, He's doing something that really is not in the best interest of the United States economy.
So, Barb, if you look at what actually won out on the week, I mean, there were plenty of sectors that closed higher. Real estate, utilities, materials, healthcare, and consumer staples. Does that offer any type of playbook if we are in this trade fight for now a more prolonged period?
Yes and no. I think there's always a short-term reaction to this volatility. We saw it in December. We've seen it in May. But I think then the market goes back to where the growth is. And I think, what we're going to see again, I mean, who knows what tweet will come out over the weekend. But we thought we had a truce here with the trade war. We did not. But now we'll see. I think that the market gets relatively inured to this. And basically, it hasn't changed the fundamentals of what we know to be true about this economy. Very consumer-driven. Consumer spending seems to be going up, listening to the credit card companies, J.P. Morgan. And that's not going to be disrupted by 10% increase in tariffs. So I think the market's still fine. I think he was right that we are fully valued, but I don't really see that we're going to do much more on the downside. Upside, we're probably not going to go back to new highs unless we get very positive news on China. So for me, it does not mean changing into a different type of rotation in terms of stocks because we see these short-term flights to safety.